Hi, and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. August is over, and we're here with Jeff's monthly review and outlook for September, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on our content. I believe we're through 4,000 subscribers, so thank you very much for all your support and keep it coming. Jeff, I hope you had a wonderful long weekend.
I did indeed. Hope you did the same, actually.
I did as well. And, there's so much, I'm sure you're working maybe just a little bit to get your monthly piece out. So, we have something to talk about today.
Yeah, we do have something to talk about. The S&P had a difficult time in the first, few weeks of August. We put in a down nearly 6% decline in the S&P before, we arrested that decline and saw a pretty aggressive rally back. The recovery off of the August 18th low came in three waves, which is a corrective waveform and leads us to believe that the move to the upside is counter trend at some degree. Now, it's been our view that the market topped in terms of its larger counter trend advance off the October 2022 lows on July 27th. And so our view is that that probably terminated primary wave 2 up, and that we are in the early subdivisions of primary wave 3 down, which suggests that this counter trend advance is near a terminal point if it hasn't already ended, and will roll over to lower lows. That being said, there's just a lot going on, a lot of moving parts under the hood. And, I guess rather than spoil the show, I'd rather just kind of address them one by one. So we'll kind of leave it at that.
Okay, so I'm looking forward to getting deeper into all of this. So our old friend, the Cycle Composite, we've been, going back and forth on this one for a few weeks now, a few months. It does look like it's getting a little bit toppy here.
Yeah, consistent with our view that we would expect this counter trend advance to be topping. Now, in all fairness, if we take a look at the historical seasonal data for September, it's a little front end loaded on the downside. It is the worst month of the year for equities, looking at data going back to 1928. And the average decline for the S&P is about 1.56%. But most of that comes in the first 2 weeks. It's usually September 2nd through September 14th is the biggest portion of the decline. There's usually some partial recovery into month end. So, it could very well be that things are playing to the calendar that way. But I would also throw out there, in addition to the Cycle Composite, which, topped in July and is expected to bottom in late November, there are actually 6 Montgomery cycle turn dates within that entire window, which is extremely unusual, okay? And they go September 14th, September 28th, October 14th, October 28th, and November 13th, November 27th. Now, if I was a betting man, I would bet that we'll probably see a low on September 14th and a rally off that low into September 29th, and then a reversal to the downside into the October 14th time horizon, which is typically where the stock market bottoms in this seasonal period, right? And if we did see that occur, then we could see another rally into the October 28th period. And then again, I would expect another sell-off into November 13th, possibly extending to November 27th, which is kind of where the Cycle Composite is expected to see its lows, and then a rally into year end. Now, here's where I would say things could surprise, okay? That October 14th and October 28th are major Montgomery cycle turn dates. That's where Paul McRae Montgomery actually saw 2 cycles converge at those dates. The others are minor turn dates. So I would suggest that we could see the biggest surprise occur within that time frame. And my suggestion would be that most people kind of look at the heavy blue line kind of being the expected path of the S&P. But trend is more important than level. And the trend being down could be significantly worse than what the cycle composite is illustrating, right? And so I would suggest you could see a fairly significant drawdown between that, October 14th through 28th period, either into the 14th or into the 28th. And my suspicion is that it could be toward the latter side of that. And so, what if we did get a situation where the market sold off aggressively? Now, I'm not saying an 87 crash, but I'm also not ruling it out. Okay, and if you take a look at what the expected return for the S&P is, it's only 10.5% this year. And we peaked it up 20%. So I put that horizontal line in there to illustrate where 10.5% would be. What if we took out that level and put in a mid or late October low that was substantially below that 10.5% level, and then rallied back into it for year end? That's one scenario that we're playing with right now as a real possibility.
Very interesting when you overlay that line. Definitely something to keep an eye on. So I do want to remind our viewers that this is obviously your big monthly piece. You look into various asset classes, regions, fixed income products, and broad-based equity products to give an overall picture of portfolio positioning. So I just want to urge our viewers to make sure they check things out on the full piece. So, Jeff, before we go deeper, can we have a look at the big picture and the longer-term economic cycle model? Are things still looking like they're in a longer-term downturn here?
Yeah, this is an illustration of cyclical market data. We tested all the major averages back in our Luthold days. And what we determined is the most cyclical major average with the longest period of history is the Dow Transportation Average. And so what we did is we detrended that price data, and we're really just looking at the momentum of that price data over a quarterly over the last 110 years. And you can see with reasonable precision a sine wave. And that sine wave tends to bottom about 34 years apart. That's a Fibonacci number. So we have, kind of a period of 17 years of feast, 17 years of famine that has occurred repeatedly over the last 110 years. If this cycle remains intact, and I have no reason to doubt it, then the cycle probably peaked last year in 2022, right on schedule. And for the next 17 years, the cycle has a downward bias. What does that mean? Does that mean the market's going to go straight down? No, what it means is that the economic cycle has a downward bias. In other words, the last 17 years have been more or less pretty damn good, right? And for the last 12, 18 months, it's been flat. And, if we look forward, we should expect, based on history, the next 17 or 16 of those 17 years could very well be to the downside or have a downside bias. So, the cycle is not slated to bottom until about 2039. And so, our suspicion is that it's going to be a tough, couple of decades here for economic growth and for equities. And our suspicion is that is going to be driven by an environment where interest rates are significantly higher for the next 16 years than they've been for the last.
Very interesting, and also quite scary when you're throwing around 17-year numbers. We've seen a mild reverse in real M2 money stock. How's this playing into your thoughts?
Yeah, so we're looking at real M2 money stock. We could look at nominal M2 and it's also negative, but the real number is the best way to look at it, in our opinion, because it gives you kind of an adjusted view of what things look like for inflation, right? Going back the history of the data, which goes back to 1960. And so over that period of time, we've actually seen past extremes of minus 6.5%. Well, in April of this year, we blew right through that and got to a low of about minus 9.1%. And that followed an extreme of positive 24%, during the period following COVID, where the Fed and the administration were throwing heaps of fiscal and monetary policy support on the economy, right? That, resulted in a spike in real M2 growth, right? And so we're basically correcting that spike. And the real question that we've been asking is, well, wouldn't it be reasonable to expect the pendulum to swing to an equal extreme in the opposite direction? And we haven't seen that yet, but we've certainly taken out past extremes. Now, most recently, we saw a slight downtick to minus 6.8% from the previous month's minus 6.5%. So that suggests to me that, well, it's possible that we're asserting on the downside, so to speak. And so, we'll see. My suspicion is that real M2 growth is probably got a downward bias for the next several months, if not years.
Very interesting. And if we're looking at the economic conditions dashboard, are we still on track for a recession?
Well, this is the LEI index, and the LEI is the leading economic indicators. These are not the lagging or the coincident, okay, which there are, a cadre of each, right? But this is the group, and this is the group that tends to lead the market. And historically, if you use the conference board's data as they do, they've just looked at this data going back to 1970 and said, well, look, every time the LEI index posts 2 consecutive monthly declines of minus 4% or greater, it has resulted in a recession, a subsequent recession, 100% of the time. Okay. Now, the average lead time has been about 8 months, in a range of about 6 to 18 months. So we're currently at 13 months and counting, and we have not seen a recession per se, which is 2 consecutive quarters of negative nominal GDP growth. We did see 2 consecutive quarters of real GDP growth come in negative last year, but not nominal growth. And so, I think that that's something to look forward to. Not if you're a bull and you're long the stock market, certainly not something to look forward to, but something that we're going to see going forward. And so, our opinion is the LEI index as an indicator right now has a perfect track record. I don't expect that to change. It's just a question of when, not if.
When, not if. So our favorite topic is inflation. How are things looking on the inflation dashboard?
Yeah, so they've improved actually, and not surprisingly, right? Base effects had kind of always been set so that we should expect to see improvement, right? As these big numbers in 2022 fall off. Here's what's really happening though. If we look at core inflation has remained stubbornly sticky, and the Fed has a number of ways of calculating it, right? There are 9 Federal Reserve banks. I think 6 of those 9 have created independent calculations of core inflation. And so we list them here. And this is actually the Atlanta Fed's inflation dashboard that we've hijacked. And we think it's a great illustration of all of these, aggregate measures, right? And only one of them is still coming in, above levels that prevailed a year ago, which is better than the last couple of months where we had 3 and 5 and 7, I think, over the last 4 months. So we've seen a lot of those fall off, and they're improving, right? But here's the deal. Okay, the Fed's target, and this is a self-imposed target of 2%, is still below where core inflation is coming in. Core inflation is coming in around 5.16, okay, 5.16% on average, looking at these 9 calculations, right? And we can look at core PCE, and we could say, well, actually core PCE, which is the Fed's preferred measure of inflation, actually ticked up last month, just a hair to 4.2%, but nevertheless, it was up, it's going in the wrong direction. So, I think what we've got to contend with here is some relatively sticky data that is unlikely to, collapse to 2%, as all the bulls out there would like to see, right? And there are some vocal bulls who have based their entire case on improving inflation. Now we get the CPI today, and CPI is not the core PCE, so it's going to be a better number most likely. And I think that bulls will lean on that a little bit more. But I would look at things in the aggregate, and in the aggregate, core inflation appears to be stickier than the bulls would hope.
So if that's stickier, and the Fed's maintaining their 2% target, what are your thoughts on the Fed's next actions?
Well, the Fed's kind of put themselves in a situation, right? They are data dependent, so they've left themselves, a way to adjust. But at the same time, they've led everyone to believe that they're on hold. Okay, and I think it's believed without a shadow of a doubt now, about 93-94% probability that the September meeting will be a hold. In other words, they will continue their pause. They will not make a change, and then they'll be data dependent until the November meeting, right? And so, at this point, if the data continues to, ebb and flow in the direction of lower inflation, I don't think that there will be a catalyst for them to raise rates. That being said, I don't think there's going to be a catalyst for them to lower rates anytime soon either. Now, this could change in 2024. And, the consensus is that the Fed is going to cut rates about 125 basis points from where they are today, beginning in March or May. Maybe it's May. I can't remember exactly. But at the end of the first quarter, anyways, there won't be any change in the consensus view. But into year end, from first quarter 24 into year end, they expect 125 basis points of Fed rate cuts. Now, I see one possible path to get there, and that is the recession that the LEI index is forecasting materializes either late in the third quarter or in the fourth quarter of this year, and we start to feel the full force of it in the first quarter of next year, at which point the Fed will then react to it. The Fed doesn't anticipate, they react, right? And so that, based on the length of the hiking cycle, right, I would say that, and the inversion in the yield curve, which has been, 13, 14 months now, right? I think that we're going to have a longer than expected recession when it does materialize. It could last upwards of a year or longer. And so that would make sense that the Fed would be cutting into the end of the year next year by at least 125 basis points if we're in recession.
So while we're talking about recession, let's talk yield curve as well. Are we seeing a re-steepening yet?
We are. In fact, if we take a look at today's data, right, as of yesterday's close as opposed to month-end close, we're now looking at a 10-year, 3-month spread of minus 125 basis points. That compares to the April spread, which was the extreme of 215 basis points. So we've tightened that by 87 basis points, right? And that steepening, that steepening is an indication that we're moving toward recession. It's the inversion that has been kind of the shot across the bow that a recession is inevitable, but it's the re-steepening of the yield curve that indicates that the torpedoes are in the water. Now, some people look at the 10-year, 2-year spread. That's also re-steepened as well. In fact, that is now negative 67 basis points as of yesterday's close, up from 106 basis point inversion. So that's a 39 basis point re-steepening that we've seen there. And same thing. I don't think it has to go positive. I just think the re-steepening effect, which is now a trend in force for several months, indicates that the torpedoes are in the water and that recession is inevitable. And it is just, the clock is ticking right now. And really, it's more of a stopwatch than a clock.
So let's get back onto the markets. You've been questioning the quality of this rally for several weeks and months now. Do you want to talk us through your thoughts here?
I do. I would just put it this way. People are looking at the major averages and they're saying, well, the NASDAQ's up 44%. The S&P 500's up 17.4%. these are stellar numbers. In fact, these are bull market numbers, right? The reality is the concentration of that performance has never been narrower. This performance is led by a handful of tech and discretionary stocks and, artificial intelligence darlings that are up enormously. Nvidia is probably the poster child, which is up, over 200%. The way to kind of think about this is, what is the average stock done? Well, the average stock's up about 5.8% versus 17.4% for the S&P cap weight index. That suggests that there's a lot of stocks that are underperforming. In fact, 72% of the constituents in the S&P 500 are underperforming the benchmark index itself. But more importantly, Mehdi, 38%, a full 38% of those stocks in the S&P 500 are negative year to date. And this is through August 31st. It might be off a little bit, 1% or more. I'd expect it to be worse, actually, just based on the last couple of days' performance. But I would basically say this: it doesn't make sense to me that we're in a new bull market when more stocks in the index are negative year to date than are beating the index itself year to date. And that's the case. Only 28% of the stocks are beating the index and 38% are negative year to date. So from my perspective, you've got this highly concentrated area of performance, area of leadership. It is tech, it is AI, it is some discretionary like Tesla, for example, Amazon.com, for example. Some of the travel stocks have been leading, Booking.com to be, as an example. But I think that this is going to be fleeting, and in my opinion, those stocks have a greater risk of seeing a momentum reversal. And some of the defensive names like healthcare, for example, has a strong potential to see a momentum reversal to the upside. And healthcare has been one of the underperforming defensive sectors.
So, Jeff, let's have a little look at the technicals again. I know you touched on some levels earlier, but are there any major changes in the preferred Elliott wave counts?
No, not at all. In fact, on the right-hand side of this chart, you can see our primary degree Elliott wave count. And what this is really showing is, the last 4 years, the advance off the 2020 lows in March 2020 into the January 2022 high. We believe that was the end of primary wave 5, of cycle wave 5, of super cycle wave 3. From that level, we saw a decline into the October 13th low last year. That was primary wave 1 down. We get there by counting 5 waves down, an intermediate degree of trend. That actually traced out a rare leading expanding diagonal triangle. And you can see the inset chart is a textbook illustration of an idealized form of that pattern taken from Frost and Prechter's classic Elliott wave principle. And we think that this is the poster child for that textbook pattern. Now, the rally that we saw off of the October low was counter trend. It traced out an ABC zigzag form. The initial A wave was just a standard impulse, 1, 2, 3, 4, 5, at minor degree of trend to finish intermediate wave A up. But then we saw kind of an unusual expanded flat pattern, or actually just a traditional flat pattern. ABC, where the B wave overtakes the prior high, and that threw a lot of people, including ourselves, for a little bit of a loop. We thought, well, we traced out an ABC zigzag, on I think December 13th, or actually February 2nd. We could have called that the end of the counter trend advance. But then we saw that sell off into March, and that terminated right about the same level that the initial decline did. And that left us kind of thinking, well, all right, we've got to refigure where we're at here. This looks like a flat pattern. So the entire intermediate wave B leg traced out a large degree flat. And then we saw this final advance into the July 27th high. And that was also punctuated by a number of extensions. It was a 5-wave impulsive advance that saw an extended 5th, and an extended fifth of a fifth. And so, that extension process made identifying the terminal point of this counter trend advance very elusive. We were confused for a number of weeks until we saw the final highs in July 27th, and we believe that marked the top of primary wave 2 up. And so if that's correct, then we are now looking at primary wave 3 down in progress. We're in the very early subdivisions. So far, we're counting minor wave 1 down, minor wave 2 up, and we think we're in the very early stages of minor wave 3 of intermediate wave 1 of primary wave 3 down. So this is going to be a doozy, and it could carry the S&P certainly to new bear market lows, but we think in the mid 2000s, possibly as high as say 2750 down to say maybe 2350. But ultimately, if you shift your gaze to the left-hand side of this chart, you can see the bigger picture view. This is a 14-year view at monthly bars. And what we're looking at is we're looking at the entire move up off of the March 2009 lows at the end of the Great Financial Crisis into that January 2022 high. And what we're really looking at is cycle wave 5 up. And so we can see the magnitude of the decline really doesn't look like much when you compare it to that advance. We haven't really even retraced 38.2%. And we think we're retracing a super cycle degree advance that really extends back 90 years to the 1932 low. And if we're correct about that, well, and if our economic cycle model is correct, the next 16 years are going to be, not great years for the economy, then it stands to reason that a super cycle degree correction could extend for years, possibly decade or longer. And we think that this could trace out a very large degree ABC zigzag corrective waveform at super cycle degree of trend. And if that's correct, the wave A down portion that we are in the very early stages of could carry down to S&P 2250 before it terminates. Now, from that point, we would expect a massive counter trend advance to retrace perhaps as much as 1/3 to 2/3 of the entire decline. That will be a very tradable bull market event from a cyclical bull market perspective, but it won't go to new highs. If we're correct, it will be followed by wave C down once it terminates. That will be a B wave corrective waveform. And wave C will carry to new bear market lows that will be well below that 2250 that we're talking about for wave A. And we've postulated a range of around, say, 1,000 to 1,400 on the S&P 500 before that cycle wave C of super cycle wave 4 terminates. So this is a very big picture structural view. It could take years, if not a decade or more, to completely play out. And we don't want our viewers to, judge us based on today's performance or this week's performance. You got to stick around for this one, because if we're correct, if our analysis is correct, it's going to be, paramount that you understand the degree of trend that we're correcting and how big this correction could be in the grand scheme of things.
So one of the things that you'd expect to be tied to this would be volatility. And it looked like volatility was on the rise, but it seems to have rolled over again. What are your thoughts on this?
Well, yeah, I've got a lot of thoughts on it, as you know. And, my conversation with Jim Struger a couple months ago probably, parsed out a lot of the details. But let me structure the conversation this way, okay? There's two indexes that we're following closely. You're showing the VIX in this chart, which is a monthly view going back, I think, to 1990, if I remember correctly. And the VIX is about 14%. It's broken down. It's testing its recent lows. I think it got down to minus or to around 12.5% previously, and so we haven't quite hit those lows. But what it speaks to is complacency, right? When we get down to these levels, it suggests that market participants are not expecting a negative event, okay, that they've repositioned bullishly, right? But if we think about the skew index, which is not illustrated in this chart, but the skew index, which we've talked about many times in the past, actually, the easiest way to think about it is it measures the proclivity of options traders to want to be buying out of the money calls versus out of the money puts, or vice versa, right? And so the skew would normally have a level of 100, would mean that it's perfectly balanced. That's a normal distribution, right? But when the skew gets elevated, and it currently spiked up to 144%, not its recent high, but a rally off of its recent low of 130%. Well, what's happened there is we've seen options traders are now buying more. There's a resurgence in demand for out of the money call options, right, versus out of the money put options. And so they've shifted their bias back toward the bull case, right? So we got this little shakeout in August, but now they're like, nope, soft landing. We're betting on a year-end rally. We're betting on a soft landing, a recovery here. And as a result, they are looking to buy out of the money calls. Now, this kind of flies in the face of what we're seeing with the equity put call ratio.
So, well, let's dive deeper into that a little bit. So the put call ratio is at odds with the VIX, is basically what you're saying.
Absolutely. In fact, we've seen a move up from recent lows. We got to in the neighborhood of around it's down toward its recent lows. And I can't remember the exact level, so I'm not going to say it, but we've rallied off those lows, and we're at about 0.77, right? And this is the 10-day moving average of the equity put call ratio. Now, typically when you get above 0.75, it's illustrating, some anxiety in the market. There's a greater level of fear. There's a greater demand for puts relative to calls. There's always a bias toward calls, but at 0.75, we're seeing that bias toward calls reduced, right? And so there's more hedging activity going on. And typically at these levels, you would suggest that options traders are fearful. They're anxious about market action. That's exactly the opposite of what we're seeing in the VIX right now. And so the only way that I can really explain this that makes sense is that there's been a shift back away from this classic put spread strategy that many institutional investors had been putting on, where they've been, selling, they've been buying protection, but they've been selling extreme downside protection, right, in order to fund that protection. So, they'll buy, say, a S&P 4400 put, right, and then they'll sell an S&P 3800 put. And they'll do maybe 3 turns on that in order to fund it. And so that put spread strategy had been going on all summer. It looks like they're taking it off now. And it looks like they're managing risk more seasonally, where we're just outright buying some puts, right? But we're also buying out of the money calls, right? Because we tend to be bullish. We're betting on that recovery, right? But at the same time, we recognize the seasonal volatility of the September-October periodicity. So that's, I guess, the explanation that I would throw out there.
And Jeff, you've been on this topic of valuations and earnings growth for several months now. And, obviously at the levels we're at with the S&P, more and more pundits are talking about our earnings growth consensus numbers too high, where the valuations start coming into play to put a cap on movement on the S&P. I don't want to rehash, obviously, everything we've kind of been discussing over the last several months, but you've been pretty firm on this. And, do you still stand by your thoughts on valuations and earnings growth numbers being too high?
Yeah, if our work that points toward a recession is correct, and if we do see a recession materialize in the next few months, we've got 4 months till year end, I expect to see some pretty significant data to support it in that period, then I think we're going to have some pretty big revisions to the downside in terms of earnings. Now, keep in mind, earnings were down in the fourth quarter last year, like 1.5%. They were down 3% in the first quarter this year. We just printed preliminarily down 5.3% in the second quarter, okay? These are year-over-year growth rates for the S&P operating earnings, EPS, and they're all negative for the last 3 quarters. Now, the consensus expects third quarter operating EPS to be flat. I don't think that's going to happen, okay? I think we're going to have another negative number, a big negative number, probably, minus 5% or worse. I also think that fourth quarter estimates are off the reservation. I think currently we're looking for like up 9% in the fourth quarter, more than that, I think. I think we're going to have a negative fourth quarter year over year as well. And so we're currently at 207 versus the consensus, which I think is now 222 for this year. Next year, we think earnings will have to be revised down dramatically. The consensus is currently at 244. We're at 187, okay? And that's my base case, all right? My worst case scenario is 155. My best case scenario is 200. So, I don't think it's realistic right now, the 2024 estimates at all. In fact, we're 25% below street consensus. Now, the street has also got a preliminary forecast for 2025 out there of 278. We think that's utterly ridiculous, okay? We haven't even printed 222 yet. The all-time record high in operating earnings for the S&P 500 is 218, okay? First, I think before you go out with the 278 number, we got to print something above 218. We have yet to do it. 218 occurred in 2022. So, I rest my case.
I think that's very fair. Very big numbers that need to be addressed. So I want to pick on you on a couple of sectors. But before we get that, something that's been in topics everywhere and is tied to everything that we're discussing is the US dollar. What are your thoughts on the US dollar here?
I'm bullish.
Well, that's good to hear.
Yeah, I think, the US dollar's traced out an interesting pattern over the last several years. It was a lateral consolidation pattern, right? And that lateral consolidation pattern is really well defined. And we saw a nice breakout above those highs, right? And it carried to about 114, I believe. And then we saw this pullback, and the pullback held that par level, that 100 level on the dollar index on a monthly closing basis consistently. And our view had been, as long as we can close above par on the dollar index on a monthly closing basis, then we think this bullish pattern's intact, and it projects to 120. And so our view, and we just applied an Elliott wave count to this to try and, assess where the upside potential was and where we were in this process. And we think we just pulled back and put in a fourth wave low last month. And if we're correct about that, we're off to the races here. I think we're currently 104.5 or so, give or take, on the dollar index. We expect the dollar to carry to 120 minimum with the next advance. So we're going to stick with that, and unless and until we get a monthly close below 100 on the dollar index, at which point we'll have to reassess.
So, Jeff, you obviously have your top trade ideas for subscribers. Unfortunately, as I'm not a subscriber, can you just talk through some sector choices on a broad level?
Yeah, as you know, technology has been the leading sector, followed by communications. These two sectors, on looking at our monthly relative strength work, continue to rank number 1 and number 2. The problem is we're seeing a deterioration in that momentum. And so relative strength for these sectors is fleeting, right? And what we're seeing as a comeuppance, okay, is energy, industrials, and materials, and also healthcare. But of those, the standout is really energy. And energy, I think, has some interesting fundamental dynamics. And when I say fundamentals, I mean supply and demand. That's the ultimate fundamental. My technically oriented viewers will say, wait, that's technical, not fundamental, but it's both, really. And we have a supply demand imbalance. Demand just hit an all-time record high. Okay, so demand is not dispersing, right? It's not deteriorating, despite a shift to more green-friendly energy sources, right? Wind, solar, nuclear. These areas are not taking from demand for fossil fuels. And what's really driving the price of crude oil higher is supply. And what we're seeing is, the Saudis and OPEC have decided to curtail supply because they need oil to be north of $80 a barrel. And they're playing chicken with the Biden administration, who did not like, lack of adherence to their plan. And so the Biden administration decided that they were going to liquidate the Strategic Petroleum Reserve. Well, now we're looking at the lowest SPR reserves since 1983. We've liquidated some 60% of our SPRs, which makes it unlikely we're going to continue to liquidate. In fact, we did replenish them to some extent over the summer. I think about 6 million barrels were delivered last month. There may be more on the way this month. I can't remember exactly what the number would be. But at the end of the day, those reserves have been sufficiently depleted that there's really nothing we can do. And, the ball is totally in OPEC's court. And if they decide to curtail supply, it'll be difficult for the U.S. to offset that, short of allowing new drilling prospects. And I don't think the Biden administration is going to pursue that. But I think if we, accelerated fracking and, wildcatting in the U.S., then, within a year, 18 months, we could be back up to equilibrium again and contain prices. But at this point, it looks to me like we're going to challenge the $90 a barrel level. We've thrown that number out a few times over the last few months. We're almost there now. If we take out 90, then the next stop is 130, and then 150, and then 300. And so, there you have it. I mean, there's a lot of upside risk to oil prices. And if in fact we do see oil prices get away from the powers that be, okay, and we do see a run into triple digits, then I think energy stocks will begin to perform dramatically better, the way they did in 2021, 2022. And, my suspicion is that we could see that complete leadership shift favoring energy, right? And so energy is our number 3 ranked sector on a structural basis right now from a monthly relative strength perspective. It's our number 2 ranked from a weekly relative strength perspective, but it might be number 1 this week. It was number 2 last week. I see the breakout in energy that is happening today, actually. That is very, very bullish for the energy sector. And in fact, if that would have happened by August 31st, we would have upgraded our opinion on energy from neutral to bullish. And, we don't usually do a mid-month upgrade, but we'll probably emphasize it in our weekly playbook next week as being a place to be heavily positioned. We've been emphasizing energy all along. Don't get me wrong. This is one of our preferred areas. We like the infrastructure play, so we like industrials, energy, and materials as a nice long-term structural play. This is where roughly $1.5 trillion has been earmarked for disbursement over the next 10 years to support projects in this arena. And no one benefits more than energy, industrial, and material stocks for that 1.5 trillion. That is a funded trade, okay? They're not going to pull that funding, okay? It's going to happen. And so this is probably the closest thing to a sure thing that you're going to find. So we've been emphasizing that as a place to be positioned. I'm not going to throw specific names out, but our subscribers know where our bets are on this and where we expect things to play out.
Well, definitely going to keep an eye on that space. It looks very, very hot. Jeff, as always, thank you so much for sharing your thoughts from Alpha Insights.
Always a pleasure, Mehdi.
I want to remind our viewers, check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.